get started. Just looking back on performance over the days, over the weeks, over the year, given the time of year. Obviously, it's been a bit of a challenging post-Christmas period, actually a challenging 1 month. I mean, that's somewhat surprising to me, actually, just to see that most sectors are down and significantly down on the month. I didn't have the feeling that December was such a tricky period, but it was actually. And certainly the second half of December, the 1 week performance that sort of encapsulates the last week of the year. Some rebounds in pretty unloved sectors like oil and gas drilling. We looked at that during the week, but a lot of that energy rebound in the week was with the drillers. I don't know if that's related to what is possibly coming down the line from Trump in energy space deregulation. It's not really related to the change in the oil price because oil price changes tend not to affect the sort of oil field services all that much. It's more sort of the future outlook for demand and of course their ability to drill for oil. I mean, if Biden gets his way before he goes, that may put a bit of a stop to that nascent rally in some of those stocks. But yeah, just an interestingly mixed picture, I think, as we went into the end of the year. The 3-month picture, albeit to say on Friday, a nice little bit of a rebound, a little bit of relief for markets, and we'll touch on why in a little bit. On the 3-month and the half year and the 1 year, a bit more of a mixed picture over 3 months with consumer cyclicals, tech, communication services, financials all outperforming post the election. Some of these sectors are not quite what you'd think they would be. Perhaps communication services has got Google in there, Netflix, consumer cyclical has got Amazon and Tesla, technology, probably a bit more as you would expect, some financials as you would, but a lot of the companies that we think of as tech companies actually sit within these other sectors and in part explain their very impressive returns over the year and over the half year. But certainly it's not been all rosy for all sectors. This is just a chart-based view. Most things going up over the year, tech, utilities, but things like basic materials, the likes of Rio Tinto, gold mining companies are also in there, chemical companies in there. A pretty awful Q4 for a lot of those guys. So maybe there's some opportunities there. Going into 2025, if China does manage to restart its economy and stimulate, say communication cyclicals doing well as one would expect. Defensives had a good early part of the year, but then pretty much leveled off as interest rates started to move higher. Energy's been up and down. Financials took quite a nice jump post the election, but since then have come down. I think financials could be an interesting area early this year, particularly as we should see more deregulation in that space. I've been a little bit surprised actually just by how much they've underperformed from the sort of post-election peaks, particularly as interest rates were going up over this period, and that tends to be good for financials, but that one's a little bit confusing. Healthcare, I suppose the common perception of healthcare is it's been terrible this year, but actually that really only started from September, and it has been a bit of a dog since September. That healthcare spider, I don't know that it's quite liquid enough to trade credit spreads on, but that's a pretty consistent downtrend, albeit it should break out at some point. And real estate, I'll have another chart of real estate a little bit later with the home builders. It's obviously took a nosedive as interest rates have moved higher. And maybe we'll all start talking about a housing market collapse again, but probably never happen. One of the nice things about FinViz, I think, is we can get this sort of chart grids. I'm not going to talk about any or indeed all of these stocks. It's just an illustration of sometimes it's quite nice to eyeball a sector And so what I've done here is I've taken the tech sector. I went into the custom on FinViz and I ranked by market cap, and then I just plotted the chart. And it's interesting. Certainly can see the relatively lackluster performance of Nvidia since mid-year. Some fantastic charts here for credit spreads. Unfortunately, SAP is a ADR, so it really isn't liquid enough for credit spreads, sadly. But we talk about sort of identifying good candidates for bull put spreads. I mean, that just looks fantastic. It's just sitting in that uptrend. These guys might be interesting, Cisco as well. But I'll often use these sort of big picture charts to just try and, I've got a sector I might be interested in, and I'm just trying to zero into who within that sector looks the strongest from a technical point of view, leaving aside fundamentals and everything else. And that can sometimes be a good way to zero in on opportunities. So that's obviously, this is a bullish sector, most stocks going up, aside from ASML, one of Europe's, well, probably Europe's main tech company, suffering a little bit this year for various different stock-specific reasons. But again, liquid enough to trade on the long side options from, but probably a bit of a struggle if we're trying to sell options. Basic resources, this bunch of charts just looks pretty shocking across the board. Interestingly, the biggest market cap in basic resources is a UK chemical company. At least that's how it's described, Linde. This is Rio Tinto, BHP Billiton, all suffering post the Chinese stimulus that never was. So you see that, these guys, to an extent here, they all spiked on the prospect of China turning on the liquidity taps and flooding their country and the world with stimulus, but it never really came through. So while Chinese equities are up, Chinese large caps, FXI, up 30% on the year, actually outperformed S&P as an aside. The likes of Rio Tinto and BHP, some down on the year or flat on the year. So if you wanted to play the Chinese stimulus story in a slightly different way, you don't want to be long Chinese stocks, you don't want to be long an ETF, you want something more stock specific, and maybe you've got a commodity view, then there's definitely value in the likes of Rio and BHP at these levels. And they should be beneficiaries as well of a continuously growing US economy. This is the mega caps within the comms. I just put it there because Google are in there twice. So good. You have to say it twice. Just because they're two different share classes, but in general, Meta, Google, Netflix, T-Mobile as well had a very strong run until they came off into year end. So sometimes some names you might not expect in there, and this is the financial space. Say again, not all of them super liquid for credit spreads, but certainly some interesting, again, some very solid, strong uptrends within the financial space, and maybe some opportunities with the likes of Wells Fargo, Bank of America, JPM, Berkshire Hathaway, all off the highs. I put together a custom portfolio on FinViz of overbought financials a while ago. I guess just post the election, because I was looking at, I think 2025 should be a good year for financials with interest rates at the long end going higher, because whether or not they're regional banks or the big banks, if they have some sort of retail operation, that they typically lend short, they charge clients the long end interest rate, and they pay them the short end interest rate. So when curves are steepening, that tends to be good for financials. So when the longer term interest rates are going up relative to the short term, financials tend to outperform, and curves have been steepening. So I find it somewhat interesting that the financials have been struggling a little bit, and we do expect to get a bunch of deregulation coming down the pipe on inauguration day and post that. So again, maybe there's some interesting opportunities within financials in the new year, and for credit spreads as well. I mean, these guys are all JPM, Visa, JPM, Mastercard, Bank of America, Wells Fargo, all perfectly liquid for credit spreads. Berkshire Hathaway, maybe not so much, but again, it doesn't look quite so attractive. So again, financials could be an interesting hunting zone for you in January for credit spreads, albeit January is looking a little bit tricky. A lot of talk over charts like this that I pulled down off a zero hedge, and yes, I don't know why people insist on these black backgrounds. It's a horrible color scheme, but I didn't have time to chart it myself, and I wanted to show you the sort of charts that are doing the rounds. So yes, depending on how you draw the lines, SPX looks like it's at a key technical juncture. It certainly looks possible that we're seeing a similar kind of price behavior that we saw in August before we had the big sell-off, took us down to the 200. That's not on this chart. 200 is down here, and it was down there, so the 200 looks a little bit like that. So in August we had this again similar kind of thing. We had a sell-off, we had a rebound, we had another sell-off, and then we had a proper bottom fall out of the market type moments before everything recovered. And the catalyst for this was worse than expected data, a market that started worrying about recession, albeit in hindsight, much ado about nothing, and also a low liquidity month in August. We had a Fed meeting in there, a Fed meeting that they skipped, they didn't cut. And then we had a more hawkish than expected Bank of Japan, and that prompted a bit of a unwind in carry trades and a bit of a liquidity moment for the Nikkei, which sort of spooked markets for a few days in August, but we quickly recovered as we realized the world was not ending and the sky wasn't falling in, and actually there was nothing really wrong with US growth, and then the Fed cut 50 basis points. So everyone got back on track, albeit with a little bit of volatility. This time around, we've kind of seen a similar pattern. We had a shock here, a hawkish surprise from the Fed, longer term inflation expectations, interest expectations moving higher. We had a sharp recovery, and then we had this sort of post Christmas hangover periods where we had a lot of selling from pension funds. We'll see a little bit later. Goldman's prime book saw a lot of hedge fund selling in that period. It was a liquid. That's kind of taken us down to where we are now. And then over this period, so over here, next week we've got Fed minutes, which may reinforce or otherwise the hawkish perception the market has of the Fed. We've got payrolls coming up the next Friday. Again, at the margin, if the number was stronger than expected, it would reinforce the sort of jitters around jitters around interest rates moving higher. And then the next week we've got inflation, and then we got inauguration, and then don't forget we do actually have another Fed meeting at the end of January. And yeah, put maybe a bit of a head and shoulders pat in there, Travis. Yeah, possibly. I think that's probably one reason why they've drawn this line here. So there's a lot of catalysts coming up in January, and we go into a month of catalysts in maybe not the best shape, shall we say, from a technical point of view. Albeit Nasdaq still looks okay on a very long run chart. It's still well above its 200. But there are risks out there. There's risks building in the market. There's a few things happening under the surface that are a little bit concerning. So this is from Goldman's sort of towards the end of December, just showing that over that week they had short positions increasing. So this is their um, this is a view of their prime book. So their flow in their what they call their prime book, which is basically their book of business that is facing their hedge fund clients, because they all use the prime brokerage and they basically use it for leverage. So uh, when you hear talk of prime book, what's happening in the prime book is basically what are hedge funds doing essentially. And over this period, they've been increasing their short selling of US equities over 4 sessions, to the point at which actually pretty significant. So the largest since early January 2024. And as you can see on this chart, 100th percentile over 5 years. So hedge funds selling into year end. Now they had a good year, so it doesn't necessarily mean that that's reflective of a trying to build a short position into January. But equally, they will be well aware of all of these catalysts are coming up. And while hedge fund is not a synonym for intelligence in any sense. They do tend to be more fleet of foot. We call it fast money. We don't call institutions slow money because that would be rude. But the lingo, the jargon in the finance world is hedge funds are fast money. They move quickly, they move fast, they break things, and they keep on going. Real money, the big pension funds, the institutions, as you see, I just slipped into it. We call it real money. It moves slowly. They're not the first on the, they're never going to be the first into a trade, and they're typically not the first out. It doesn't mean they're wrong all the time. It doesn't mean hedge funds are right all the time. But if you want to get I suppose, take the temperature of what informed investors are doing, you'll see it turn over much quicker with hedge funds. So that's why there's always a big focus on prime book, prime positioning. We'll see that a little bit later as well. Again, this is just Goldman's traders year-end view. Various different observations from him. Can't remember who it is. It's not Tony Pasquarello, but it's one of their head traders. So just more bearish, both bearish sentiment and bearish flow. Technical aspects, head and shoulders and S&P. Liquidity is challenging. So what we've been seeing, those sort of daily sessions where we had instant sell-off, rebound, sell-off, rebound. That's all been going on. And we're only just starting to see, maybe people dialing back what seem to be overly optimistic positions into year end and into the beginning of the year. I won't dwell too much on this, but it's useful just to keep repeating to you what the investment banks are telling their clients. It doesn't change all that much. This hasn't changed much since the election, but equal weights over market cap at the margin, and we'll have some charts later on why. Mid caps over large caps. This one allocates some assets to gold. I've never been what one might call a gold bug. I've always been a bit skeptical of what really is the purpose of gold in a portfolio. It's often what we call a lazy diversification trade, as commodities were at one time. If you stick 5% into gold in your portfolio, it will reduce your risk mechanically because of the way risk models work. So far be it from me to suggest that fund managers try to game their risk managers, but if one wants to reduce one's portfolio risk in order to allocate some more money to what you like, then throwing some gold in there is often a good way to do it. So I'm often cynical about, why people have gold in portfolios. But this time around, I think I agree with that a bit more because the biggest risks to markets for this year, and this is just not me saying this, but if we look at Deutsche Bank's client survey, what people perceive as the biggest risk to market stability are trade wars, sticky inflation, Fed hiking interest rates rather than cutting interest rates, and a valuation reset in tech and a reset of the AI narrative. Gold won't help you all that much in a valuation reset for tech, but it will help you in trade wars. It will help you with geopolitics. It will help you if inflation goes higher. All of those things are gold positive. Um, Pablo, they're not Bitcoin positive. Okay, so Bitcoin is not like gold. It has some similar characteristics to gold, but it is very different in other ways. They're both perceived as a store of value outside the fiat money system. So the kind of narrative of Bitcoin being digital gold held more water, or pardon the pun, had more currency in the era of QE, when central banks were printing money and there was this paranoia over the debasement of fiat currency, blah 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 blah. But what we've actually seen as the Bitcoin and the crypto market has evolved is actually crypto is more tied into the tightness, the looseness of the financial system to some extent, and also investor sentiment. Um, so interest rates down, more money in the system, more money flows into Bitcoin. Investor sentiment is higher. People take more risk. They put money into crypto. Um, Geopolitics, big risk off events tend not to be good for Bitcoin. Inflation, you could argue it's maybe should be good for Bitcoin, but I think the inflation that causes risk assets to sell off will probably just send Bitcoin down alongside it. I definitely think there's strong arguments for crypto this year, just because of its increasing adoption, becoming a mainstream asset. But I don't see it as a good hedge. I definitely don't see it as an adjunct to gold. They're two different things. But yeah, allocate some assets to gold. I would agree with that. We'll look at that a little bit later. I know all of my previous peer group, in the sort of macro space, all have some exposure to gold. They're all writing in their year-end notes that they're going to continue to have that exposure to gold through this year for all of the reasons that I just touched on. It is one of those. It is a pretty attractive hedge right now. The other thing that's an attractive hedge, I suppose, is just buying put options, albeit an investment bank is always going to encourage its clients to buy put options because they make money from selling them. So don't don't believe everything you read. I'm not a big fan. I wouldn't be a big fan of just buying 6-month S&P puts here. I think I'd probably do VIX call spreads. I think there's smarter trades. But I do agree with keeping an eye on VVIX, and that is just the volatility of VIX options. For those of you, we'll look at that in a minute. For those of you that are sort of a bit more internationally focused, more fundamental investors, this one is probably important. The last couple of years have not been particularly big merger and acquisition years. There hasn't been that much of it happening. There's definitely a feeling, a perception within the investor community that 2025 could be a big year for M&A, and part of that is just partly the strength of the US dollar and the amount of money that has flowed into the US. So there could be some interesting things for those of you that are a bit more fundamentally focused on in the M&A space. But for all of us, I think everyone should really have VVIX as a ticker in your watch list alongside VIX, because it gives you, I think it can act as either a confirmation or a little bit of a leading indicator on when investors are becoming worried. And I sort of choose my words carefully because I'm not saying it gives you a leading indicator of when markets are going to sell off, because the two two are not often coincident. Investors were buying a lot of VVIX, spiked in September. It spiked again in November, just before the election. Did have a bit of a sell-off before the election, but nothing significant. So people hedged into the election, and obviously wasn't the right thing to do because it was a huge up move and everything came down again. But by keeping an eye on VVIX over 110, that's why I've drawn this line. And on this chart, VVIX is the light gray line. So when the light gray line goes above 110, it tends to be coincident with the sell-off, a reasonable sell-off in US equities, or a market that's getting worried about an upcoming event and is really starting to buy VIX options. So it's worth being aware of. Can be useful. Social media, people telling you VIX is very cheap. You should buy 1 month, 16 strike VIX options, or those silly things that they often tell you to do. Just check VVIX. If VVIX is in the low 90s, like it is down here, and as long as the VIX futures price is above is below the price of the option you're thinking of buying, it might not be the worst thing to do in the world. I still prefer spreads, but this VVIX is just your measure of the expensiveness of VIX options. When it's above 100 or 110, typically it's not a good time to buy outright VIX options. It might be a good time to do spreads. So to buy a call, to sell a call, to do a put spread, particularly when it's very high, but it typically means VIX options are very expensive. So people are buying a lot of them. That can be useful to know because it tells you people are getting worried, but it can also be useful to tell you not to go in and buy expensive options. On the topic of VIX, one thing that's been pretty interesting this year is just how quickly volatility has come back after a spike. That's what this chart shows you. It's basically the change in 1 month at the money volatility. Basically normalized change over 5 days. So big spike up shows it. That's a huge 5-day move relative to the last 2 years, and what we've seen really this year, towards the latter end of this year, is this series, standard deviation around this series. Excited there. I thought that was a question. Not too many people ask questions about the volatility of volatility, but if we draw like the one standard deviation here, you can see spikes up here, spikes down here, but this really does look different, doesn't it? VIX is just going up a lot more, and it's coming down so much faster when it does go up. So much more violent moves in VIX these days, which is, these sharp up moves. That's great for call spreads, and equally these big corrections down are good if you can get in and do put spreads. So one way of looking at this chart is that VIX is a more interesting asset to trade these days than it was previously. Another way to look at it is that part of the reason for this is gamma. So the impacts, and we've talked about gamma before, and street gamma just means what are market makers doing relative to what the market is doing. If they're long gamma, they're acting to reduce the volatility of the market. Remember, if they're long gamma, market goes up, they're selling it. If they're long gamma and the market goes down, they're buying it. The bigger the gamma position, the more they're buying and the more they're selling. So the more they insulate the market. And that was absolutely the case into year end. There was like a 13 billion gamma position around about 6K on SPY, which is why it just kind of stuck. It just sort of stuck there. And that it's kind of been a thing since COVID, and we first started seeing it in mem stocks, and then it trickled through into the index. But for whatever reason, it really does seem to be more of a consistent effect these days than it ever used to be. It used to be one of these things that professional investors, well, the kind of geeky quants would look at, but most sort of professional investors would just go, yeah, yeah, most of the time it doesn't matter, pull the other one. Um, but as this chart shows you, as the gamma goes down um, to flat to negative levels, the realized volatility on the S&P tends to go up. Um, Now you might say, well, that's because the market sells off there, but this is what you would expect if gamma matters when the street is no longer acting to oppose what the market is doing, it moves more. And so yeah, that's just something to be aware of. I think maybe pay a wee bit more attention to when you see people talking about gamma. Um, a high gamma tends to mean maybe not out of the money options probably are perhaps not so attractive because you just might not get that big move. Low and potential moving into a low negative gamma position. If it's to the downside, it means that markets could move a lot more as they go lower. And we're sort of sitting right here and now, as you can see. We're sitting pretty close. This was just before the expiration. You can't quite see it. The scale is cut off, but that was about a 13 billion long gamma position. That disappeared on the 31st of December, and we're now pretty flat, which again just sort of emphasizes, I suppose, the fragile nature of the market right here and now. Just before we move on from VIX, so are there more or less opportunities when VIX is low? It depends, I suppose. When volatility does tend to cluster, as we describe it. So when VIX is low, we can kind of see it on this chart a little bit. Although it's not a very long run chart. But when VIX is low, it tends to stay low for a while, and when it moves up, it can stay high for a while before it comes back down again. So tends to move through ranges, and a very low range in VIX can persist. Like 2016, 17, VIX was just so low for like the whole year. It was incredible. Lots of risks in the market, but it just would not move. So it means that there's less opportunity to be long vol. If you have structures that are long volatility, like you're trying to trade straddles, strangles, those type of things, it means that when you are, if you think about VIX, like what is VIX? It's sort of a proxy for 1 month implied volatility on the S&P 500. So generally, when VIX is low, one would expect, by and large, majority of stock vol to be lower than average. Not always the case, but yeah, at the margin, if stock volatility is lower than average, then the 25 delta strike that you sell to get into a put spread is going to be closer than normal. That's one of the ways I like to think about implied volatility as it relates to credit spreads or debit spreads, is because within a credit spread, we're typically initiating based on a delta. So we're looking for 20-25 delta. Yeah, we're not saying we always sell 5% away or 10% away. We're like, okay, where is the 20-25 delta option? A lower implied vol has the act of mechanically pulling that 25 delta strike closer, because option price goes up with IV, but option delta also goes up with IV. So the higher the IV, the higher the delta given the strike, and that means that IV higher than normal means that your 25 delta strike is further away from normal, and therefore a more attractive time to sell it, perhaps, assuming, of course, that IV doesn't continue to go up. An IV lower than normal means that that 25 delta strike is closer than normal. So yeah, at the margin, a less attractive time to do debit spreads. But one has to contextualize that in terms of the trend as well. So, you know, a low volatility regime with a really strong uptrend and you know a low vol uptrend can be a great time for credit spreads. But you're right. I think um, it's certainly not the case that while volatility does mean revert, it's very low, it doesn't immediately mean it's likely to go very high immediately. So it's typically not a good trade to buy vol when it's low and sell it when it's high. Conversely, you know, oftentimes it's better to do the opposite to buy vol when it's high or moving higher, and sell it when it's low. But let's park that discussion now. I could spend the rest of the day talking about vol and bore you to tears. Um, um, well, Dilip, VIX is in the range it's been in since COVID. That's a pretty big range. um, you know, COVID marked one of the highs. So I would say it's fair to say, given current levels of the front month VIX future at 16.7, the volatility of VIX options at 94.3, that yes, the market is not quite as complacent as it was over this period. But you know, if I took this chart back to 2022, VIX in 2022 was like this, you know, and then it came down into 2023. So yeah, I think it is fair to say that here and now, at the margin, perhaps the market is a little bit complacent about the risks in the month ahead. And yeah, maybe in part that's been because it's been used to this sort of insulating long gamma. But I think that is a bit of a risk. The other thing that speaks to that is market breadth is very poor. Loads of different ways to look at market breadth. Market breadth just, you know, again, there's no one measure, but it's just a simplistic way to describe it is our if you have good broad market breadth, it means that the market is going up or it's going down. But most stocks are making new highs as the market goes up. So the advanced decline ratio, this sort of thing here, the spread, the 1 month spread, return spread between equal weights, S&P and S&P, or you know these much more sort of complex models here that sort of Goldman's have put together. Like, you know, all the banks have these kind of things, but you know, again, oftentimes trying to reinvent the wheel. But typically, when we have a situation where it's less and less stocks making either new all-time highs or less and less stocks above their 20, above their 50, um, it's typically not a positive markets sign. It can signal a bit of exhaustion of trends. And that's kind of what the US are trying to show you in this chart, is saying that on average, this kind of market breadth that we see here, so they're sort of trying to draw the regression line through that. Given typical market breadth that changes, it's more consistent with S&P down 10% from its current level. And again, you know, you see that on equal weight S&P 1 month return spread. Typically, when market breadth reduces to these kind of levels, it's often in advance of a sell-off. As you can see here, the little explanatory blurb for this is to show that yeah, 70% of trading sessions in December had more names declining than advancing. So that's that advanced decline ratio. So that typically has fat tails, which means that oftentimes you get you can have a bigger than a normal market move, and that kind of index average of 100 often sort of precedes a 10 to 15% decline. Again, it isn't it's more of a coincident indicator. It's not a predictive. I don't think it has much predictive power, but it just sort of tells you that, again, under the surface, the market's a bit more fragile than it normally is. It's just another more simple way, if you like, of looking at market breadth. This is just charts the S&P, normal S&P versus the equal weights. Goes back to 2015. We normalized the chart in 2015, so really nothing in equal versus broad S&P until a little bit coming out of COVID, as one would expect, the large caps being better than the small caps coming out of COVID. But we all kind of bunched up again in 2022, but it was really mid-23, the likes of NVIDIA, probably NVIDIA. If I put NVIDIA on this chart, it would probably look like that. So really, the whole sort of AI boom and the mega caps and the big push higher by the Mag 7 is what's driven that. Yeah, let's just zoom in on that period. It's a 13% underperformance over 1 year. Again, another reason why going into next year, this year rather, I keep saying next year, the likes of investment, Goldman's and the other investment banks are heavily pushing equal weight indices, because even if the S&P is flat over the 2025, you could see a 13% return in equal weights just with those sort of smaller companies catching up. That's also a nod towards Q1 earnings season, where we expect you expect the sort of exceptionalism of mega cap earnings to start to come back. Another way to look at it is the S&P 100. That doesn't get looked at much these days, but it's an index called OEX, if I can manage to draw it. That's the S&P 100, so that's just the top 100 stocks in the S&P. Bit like the NASDAQ 100. I guess it's not so popular these days because the NASDAQ is more popular. But again, you can see that if we just ratio the 100 to the 500, you see a significant move higher over this period. And you can also see actually the resurgence in mega cap through December is one of the things that perhaps was keeping S&P above water. And if that is declining, again, I suppose that's another reason why you might want to be a little bit cautious about S&P here and now. But a much longer run chart back to the 2000s, it isn't always so. We had through early 2000s into the mid 2000s, a big outperformance of small caps versus large caps. So possibly still has further to go to get back to those previous highs. DLAP, I would say, I think it depends. I think typically January, and we'll have a chart a little bit later, but maybe actually this is just coincidentally. This chart shows you the volume of call options traded on the mega caps. So the sort of proxy for Mag 7, so which is a sort of a proxy for retail activity in markets, and you can see it's really come off significantly from mid 2024. So there is a lot less excitement around in the retail space these days than perhaps the peak of mid 2024. I'm not saying that there's less interesting trades around, but there's definitely a change in investor behavior. I think look, this is the daily implied move going out over January, and these are the events that are coming up. We've already had ISM, so we've got payrolls, CPI, inauguration day, FOMC, and on each one of these event days, particularly FOMC or inauguration day, the options market is pricing a 1% move or plus 1% move for the S&P, where generally it's more typically in this sort of 60, well, in the 80 basis point range. So options markets, even the VIX is not sort of telling you people are all that worried, but options markets are definitely pricing in more volatility than normal. I would say through January. It's a month where we've got a combination of catalysts coming at the same time at which technically markets look weak. Um, like we get months with payroll, we get payrolls and we get CPI and we get ISM and consumer confidence every single month. And more often than not, we have FOMC thrown in there as well. So if you weren't going to trade when you've got sort of these kind of events, well, you never end up trading. But uh, I, and that's not to say there aren't opportunities. I think one would be right to keep a closer eye, perhaps on your risk and be a bit more, just be a bit more aware, perhaps, of what a large move in markets might do to your portfolio. So, whatever way you want to approach it, sort of model what might happen to your current positions if you saw like a similar pattern to what we saw in August, because I think that's quite possible. And again, in sort of my old world, we call it a historical stress test. We'd literally do that. We just plug in to the risk model. Okay, starting the 15th of July to the 5th of August, let's rerun that and see how all of our positions do. And if anything looked particularly scary, then we try to find a way to sort of box off that risk, if you like. So that could be as simple as just looking at if you got a bunch of credit spreads, would they all get stopped out if you had similar moves in those stocks as you saw in August? It could be just modeling based on the delta of your portfolio. If the S&P drops 10%, how does that leave you? It really depends on what you've got on, but I do think that that's not a bad. It's never a bad exercise anyway, to be honest, just to continuously kind of assess. But I think given where we are in January, look at everything that we've got ahead. We could get through the month, and January could be a great month. Like seasonally, the seasonality of SPX isn't really great through this period. The first 2 weeks of the year, January, tend to be good, but it's a bit of a flat period seasonally. We don't have buybacks really coming in until we get through sort of Q1 earnings. We know investors went into the year quite bullish, much more bullish than perhaps normal. Volatility is looking a little bit complacent. Market breadth is very low. One of the big risks for next year is a more hawkish than expected Fed this year, and trade wars and tariffs, and we should get some clarity on all of that in January. So I would, if you put me on the spot and say, is the S&P higher or lower at the end of January than it is now? I'd probably say marginally lower, but in between, I wouldn't be surprised if there's a 10% drawdown. If you ask me between now and at the end of Q1, is the S&P higher or lower? I'd say it's higher. So I think January is going to be a tricky month, just because we've got so many potential catalysts and we've got a fragile market. And as long as you can get through that month, then we'll know a lot more in February about what Trump is thinking about tariffs, what they actually look like. We'll know a bit more about the labor market, how that's doing, inflation, how that's doing. We'll have another month of data. We'll have had the Fed minutes. We'll have had a Fed meeting. So again, we'll know more about what they're thinking. And I think that will then put us in a much better place to really go for 2025. So my advice would be, at the margin, almost treat January like December and just don't fully engage. Sit back, use it as a time to maybe reassess some of the risks that you're running before Inauguration Day. There's no point reassessing after that. You'll know by then. But yeah, maybe use it as a time to focus on some other types of trades that are less risky, like debit spreads. We got some ideas for gold that we mentioned before, VIX call spreads, hedging type trades. Maybe just use it as a time to sit and observe how markets react in this type of way to lots of different catalysts. It's somewhat unusual that we get a January where we've had a fantastic year, but we've got so much uncertainty bundled up in a few weeks, and a lot of that's because of Trump and Inauguration Day. So I think it's fascinating, but yeah, I wouldn't be jumping into January and saying, right, now's the time to put a lot of money to work. I just don't think it is. And professional investors don't seem to think it is either. Despite what the sentiment surveys show you, this funding spread, the red line, is, without going into exactly what it means, typically when the funding spread drops, it means there's less interest in putting on bullish positions at the margin. So that funding spread tends to fall after markets have fallen. So, as sentiment takes a hit, the market falls, and then people go, okay, just, I have to stay out of the market, or I'm forced out of the market. It's an indicator of falling activity, people not wanting to take risks, not wanting to put money to work. You can see it spiked massively after the election as people try to sort of get into positions, but this is a significant move lower. Part of that will be year end. You always get these sort of big changes in funding spread at year end. But it's just interesting that it came down coincident with the S&P selling off, and it hasn't stopped, and the S&P has bounced. So again, just at the margin, it's not a positive microstructure sign. Again, most of these things tend not to have future predictive power, but they're just telling you that if the fighter takes a punch to the face, he's probably going to go down rather than stagger back. So I'm not saying the market's on its last legs, but it's a lot more fragile than it normally is. The average yearly drawdown in S&P tends to be 14% over a 40-year period. The biggest drawdown we had last year was 8%, and the year before was similar. And right now we're a bit lower, so maybe we're due a bit of a bigger than normal correction. And yeah, Wall Street is, as always, these guys rarely predict a market fall. But yeah, a lot of people are very optimistic, and again, another reason it could go lower. But if I was put my year ends on here, I would probably be around about here. I'm pretty optimistic this year, but I think January could be a great buying opportunity at the end of January, partly because yields are going up. That's going to impact the housing markets. And I'll just scroll through this to get to, we're coming up in the end. But gold, I said right at the start, I think gold is an interesting trade for this year. And I'll just take a little bit of time just to run through why. Pablo, we spoke about gold before, so this is why I kind of think gold is interesting, but right here and now, silver is probably more interesting than gold. So gold's interesting because it's moderated, it's in a bit of this wedge pattern. There's lots of good fundamental reasons for gold to go higher next year. Gold volatility, this GBZ is a volatility index for gold, so it's a bit like VIX for gold, I suppose. So you can look at that. That's definitely not high. So gold options are not expensive, but gold itself is expensive versus silver. The gold silver ratio, so literally is just the gold price divided by the silver price, is at multi-year highs. If we take this even further back, it tends not to go much above the 90s. This was COVID. Back in 2011, it swung the other way as silver got to 50, and obviously when the Hunt brothers were cornering the market. But on the top side, gold tends not to be relatively priced much more expensive than this versus silver. So partly that's because silver sold off more since the election. So if one wanted a sort of 3 month long gold position and thought that might be useful, and I do think it is an interesting trade, it's probably more utility in silver here, because even if silver just catches up with gold, that's a reasonable move, and I think that started happening. I used to looked at this. I put this trade on last week. It started to work. But I still think there's plenty of upside in silver from here. It still looks cheap. Gold miners are something people will often say is an interesting way to play gold. They also look cheap. Likes of Barrick Gold have had a terrible year, but I use this chart to show you that there's no consistency between the performance of gold miners and gold itself. With some of them there is, with some of them it looks completely different. Because at the end of the day, a gold miner, well, they need to have gold mines, and they need those gold mines to have shiny things to dig out of them, and miners to work in them, and they need to be air conditioned, a lot of those mines. So they've got a lot more going on than simply the price of the metal. And a lot of the time they hedge their production forward. So if they were, they do it on a quarterly basis or a yearly basis, but if they got their hedges, if they were too conservative on the gold price, they won't have benefited as much by it going up. So it's a tricky trade, I think, to do GDX instead of gold, albeit it is a trade that did sort of work through. Surprised me that it worked so much through 2024 because it normally doesn't. But if you like the idea of buying stocks rather than buying an ETF on a metal, you do see a similar valuation gap in GDX to gold. See a big valuation gap in Barrick to gold. So that could be another area to look at. This is how I'd set up any trade like that, where I'm trying to take advantage of a valuation gap or a correlated series that has opened up a gap. I just plot them both on two different axes, and then I can very quickly say, okay, well, if my median expectation is this snaps back to that line, well, then I can see that means $41 for GDX, and maybe my upside is they both go back up to here, in which case my upside for GDX is 44. And then it's really easy to then just pop that into option strat. What is select, sort of try and select a long strike just below here, a short strike just above there. So your kind of median is in the middle. It looks a bit like this for GDX. It's maybe aggressive looking at March. You could push it out a bit further. You'll get a slightly worse payoff, but you'll stay in the trade longer. But just to show you that for something like that with GDX, all it needs to do is close the gap on gold. Gold does not need to go up. If you believe in that correlation, I'm not sure I do, but if you did, if GDX goes up to $41, you're making in the region of 500, 600% return. So these are the kind of trades that I think are interesting in this environment, where we've seen maybe correlated assets decouple. Maybe we've got a reason that we think the asset might, the thing they're both correlated to might do well, and a little bit of a risk off flavor to it. These are the sort of things I'm kind of looking at the moment. I prefer silver to play the snapback, just because I'm more confident that the silver and gold move together because of generally, at least one common driver. Whereas, sometimes we can see charts like this where the two assets are moving together. but there's a third driver we don't see, that it has changed here and will continue to change. So the perception is they're both kind of correlated because they're both moving to the same beat, but maybe they're not. Maybe there's a third thing we're missing. With gold and silver, I'm more confident that with gold miners and gold. And the same trade for gold and silver works. The same sort of thing, exactly the same process. Chart it, plot it, draw the lines. This time silver over here. That equates to something like 29.31 in silver. Not quite as spectacular. The price of silver, price of silver and price of GDX are much the same, so it's just as expensive to trade one as the other. Costs matter. You're right to be concerned about the fact that if you trade an asset of $26 versus one of $500, you're paying a lot more per option contract. But you don't get too many assets that are priced at sort of $400, $500 that can deliver you a 10-time return. So that's the flip side of it. If you're getting 500, 400% return, then the cost of trading is typically low relative to the potential return. But no getting away from the fact that things like VIX, SLV, EDX are more expensive to trade relative to to things like, I suppose, GLD. GLD is cheaper to trade, so that needs to be taken into consideration as well. But I think interesting trades right here and now are probably silver call spreads, VIX bull call spreads.